Morning, everyone, and thank you for joining. My name is Taimur. I am one of the senior accountants here at Awesome UK, and we have Michael here as well. Michael, would you like to start with the introduction?
Yeah, good morning all. As you might know me, I'm Michael, Economic Development Officer for Hamilton Fulham Council. Welcome to our first collaboration with Awesome. Awesome name, by the way, Timur. Yeah, you'll learn a lot. I've seen been sat in another session, and this is quite good. We're hoping to, if this all goes well, we can roll out a bit more. So thank you, guys, and yeah, pass the word on. Thank you.
Thank you, Michael. So I'm going to quickly share my screen and start the presentations. Bear with me. Okay, so as I mentioned, today we are discussing financing your business, top tips about it, recommendation, and at the end we'll go through live Q&A. Now this is hosted by Hammersmith and Fulham Council, supported by West London Business. My name is Taimu. As mentioned, I work for a company called Awesome, who is an online bookkeeping and accounting service, and we provide business guidance and accountancy and finance services to the public. Now, the agenda today is quite long. There's quite a few things that we need to discuss, understand, and see how a business can finance themselves in a way that is appropriate, applicable, and best for any business. So we'll discuss a short about ourselves and how we play a part in all of this. We'll discuss, the introduction on financing your business. One of the main topics, budgeting, forecasting, and costing. Then type of financing, which are loans and investment, and finally how to account for those and what are the tax implications for each of those. Now, Awesome is a new company that works in a way that automates the whole process of the basic bookkeeping and accounting. So the world is changing, right? And everything is getting automated. AI is playing a big part in all of it, and Awesome is one of the first accountancy firm to apply that in that whole process. So we are a non-traditional accounting firm. We provide automated bookkeeping softwares plus a dedicated accountant. So rather than just pushing the tech that we have made, we also provide the service with it. So for you, it's a one-stop solution. We are e-commerce specialists, but we work with very different industries. But e-commerce is where most of the automation has happened and requires a lot of technology behind it. Now, our customer gets direct access to their accountants, bookkeepers through a live chat. So it's very informal. It's not like, you have to book an appointment and wait for your turn. You have a chat system where you can literally, like WhatsApp, message your accountants and your bookkeepers and get an update within 24 hours. You can ask a technical question or a very simple question. You have a friend available for you on your mobile app. And yes, lastly, as I mentioned, we are a technology firm before an accounting firm, and we use the technology behind to provide that accountancy firm. So automation is a big part of what we are. A little bit about myself. I have been in different industries, and I've been doing accountancy and finance for almost 6 years. The industry that I've been involves accountancy practices, solicitors, and charities. Currently, I'm waiting for my last exam, so I'm an ACC finalist, and I'm managing a portfolio of 200 clients with different backgrounds, and majority of them are e-commerce. So that's what Awesome is. That's what I am, and that's where the whole presentation comes in place. And financing. So financing your business. Why is it important, and why are we focusing on this as a first webinar? Now, when we start a business, we focus on trying to find out the niche product, trying to find out the market that we can go into, and which platform we should go into. We try to do market analysis, customer preferences. We do a lot of things, but we don't mainly focus on the finances. But it is as equally important as anything else. You have a great idea. You need a finance to back it up. Cash is king, right? And it's the lifeblood of your business. You need enough to start, and you need enough to flow. The normal way of working on this is to generate enough initially to start, and then let the business generate the flow. So that's why you need initial financing, and you need the initial cash. Without this, obviously, your ideas cannot become reality. Competition. any industry that you pick up, it's fierce out there. There's so much competition. Everyone is trying to be on the top, and especially after COVID, where people were laid off, they started their own businesses. Market is getting more and more competitive. Now, to be on top and to be competitive, you need to have strategies in place. You need to know how much you can dilute down in terms of your promotions. How much can you to market, and for all of that, you need backing of finances. So you need, to be competitive, you need finances in place. You need to plan your future, understand your business needs, where to utilize your limited resources. Look, all of us are starting new, or at a maturity stage of a business. We all have resources, but they are limited, and we have to plan it in a way that it's used to its perfection, rather than just trying the best. So you have to plan your finances in a specific way that it only uses your resources in the best way. And the last part, where finances help, is to maintain your business relationships, your reputations, and supply chains, and it helps you innovate. Now, you when you start a business, you spend a lot of time building those relationships, building a whole supply chain. And imagine you run short of cash and you're not able to help them, support them, and pay their invoices. Now, there are small businesses, or starting businesses as well, or there are businesses who rely on cash as well. And if you're not able to provide them or pay them in time, and not finance them in time, you can ruin that reputation or that relationship, which are crucials for any business at this day and age. So planning your finances is equally important for all of those elements as well. If you want to innovate, you want to produce something new, you need those finances. If the start is poor, then going forward will always be difficult. If you ruin your relationship, if the start is not good, then obviously building that all up is another whole project itself. So that's why it has to be perfect from day one. Now, before we even talk about what are the different options available, what are the different finances we have, we need to focus on how much do you actually need, right? So you cannot simply say, okay, I'm starting a business, let's start with 50,000 and we'll get somewhere. Asking or getting too much out could be way too costly. You will be paying in high interest rates, and returning it could be a big pain. Taking out too less could break you as well, because you won't have enough to support you. So first thing first, before even starting anything, you need to understand how much do you actually need to run your business and start your business. And that's where things like budgeting, forecasting, costing, and expense analysis come in place. If you do a correct expense analysis, you will know exactly how much you will be spending on month-to-month basis. You do a good forecasting, you will know, based on your ideas and assumptions, this is how much cash you will need. And budgeting will help all of them come together. So we'll take a look at some examples, but again, as I mentioned, these are the things that budgeting can help with, to maintain and understand how much cash you need or how much financing you need. But if you don't look at the financial element, the budgeting and forecasting help you with things like not spending the money you don't have, because you've budgeted and you know that you shouldn't be spending this money. It helps you plan your business activities and focus on both short-term and long-term. And when you budget something out, you know exactly how much you should be spending, and how much you should be spending now and 1 year later. So it helps you plan that whole process out and whole journey out. And I think my most favorite is that it helps you control your cost. If you see that there's a big difference in what you budgeted and what your actual expense is, then there's something wrong. This is not what you planned. So you can look at it straight away. As I said, it raises alarms before it's too late. Lastly, when we're talking about financing, budgeting, forecasting helps funders trust your business. They know that you have done the homework, and they will look at the numbers and they will see, okay, based on these numbers, what he's saying is true as well. So if you go to someone and ask for a £50,000 loan, they will want to know why the 50,000. What's your reasoning behind the 50,000? With the budgeting in place, you can actually show them this is why you need this much money, right? So I've created a simple example, which is very basic, and it helps us understand on a very basic level on how it should work. So again, this is a budget of Awesome Company Limited. Now, I've done it on month-to-month basis. So starting from January up until December this year. So the way it should look like is The first element of it is your sales. So based on the product that you're trying to sell or the service that you have in mind, you need to think and do your customer research and market research, and assume that how much sales you will be making based on your understanding. So imagine if it's a business of mine, I thought about it, I did my analysis, and the first 2 months I won't be making any sales because first month is probably all of my setup, getting everything in place. Second month is getting marketing it, getting into the market position, and the third month is where I start making some sales in from March 2021. And I'm assuming that based on the numbers that I've looked at, I'll probably make £4,000 in selling my product, and in services I've already in touch with people. They will probably take my service in March for £3,000. This gives me an idea that probably by the month of March I'll make £7,000. But for that £7,000, my cost would be £2,200. Now, this is the initial cost that I have bought the inventory for. So I bought some inventory in February as a part of setup, and then I spent another £2,200. Now, this is directly linked to my sales in March, so that's why it's half of it. So that gives me a total gross profit. On the second month, it was a loss because I didn't make any sales. Second month, it will be around £4,800 based on the cost. Then I'll focus on all of the fixed cost. So things like rent, utility bill, salaries, insurance, accountancy fees. Every business will have their own fixed cost. Some business, nowadays everyone is working from home, so you probably won't have any rent. You might have something else, some other expenses like more salaries or cars and stuff. Now, the fixed costs are the one that regardless of whatever your business activities are, you will always pay this amount. And regardless of if you're selling £2,000 or £20,000 worth of goods, your accountancy fees will always be the same. So that's why it's called fixed cost. On the other end, and there are things like variable cost, which move the way your business is moving. If you're making more advertisement costs, you're doing more sales. If you're making more business transaction, more business fees. The more loan you take out, the more interest you pay. So the variable costs are the one that will not stay stable and will change as and when. So you plot all of those in your budget, and then you figure out that how much you will be making on month-to-month basis. So as by the look of it, you can see we're making a loss in the first 2 months, and then we start making some profit going forward. So this gives you a understanding of what your business would look like and how the finances or the money situation would look like. And based on this, you can then make decisions. Okay, this is how much I need. Like for example, for the first month, we're making a loss of £7,000. That shows that this is the minimum that we need to start a business. And going forward, obviously, when you show this to a bank or an investor, what they will look at is all the figures accumulated together, and they will see at the end of it, you're making a profit of £20,000 in the year end. So by the end of 2021, you'll be making a profit. And this is based on the assumptions that on each month, your sales are increasing by 10%. So every month, on March, you made 4,000, April, 4,400, and that increases to 10%. And by December, you're making £9,000 a month based on a 10% increase on monthly basis. So looking at this picture, it helps you to understand where you are currently and where you are pushing to be and going forward. And if you achieve this on a regular basis, then investors and lenders will see that, yes, what you are, your business, your numbers, and you're able to achieve that as well. And the way also you do that is that when you on month-to-month basis, when you're actually in that month, so for example, March has already passed, so you will come to your actual area and you will plug in the actual sales you made, and then compare it on how much you have made from what you could have made. So and that is also used for further analysis as well. So these are the tools. This is the budgeting tool that helps you understand your business finances and how you can change and manipulate it to work for you in a way that you can make good business decisions out of it. So that's budgeting. But that the budgeting is used to first control business and control your business finances, plus determine where you would want to see yourself going forward. But remember, accounting is done on accrual basis. So we're going to now look at some cash flow, which is the same thing, but it looks purely on from cash perspective, which is on this side. So again, we're looking at the same sales figures. So we're assuming that when we are selling those products, we are getting the money back on the same day as well. So remember, the sales is not equal to your cash. The sale is what you have committed to, and cash is what you've actually received. So on that basis, when you sell a product, you receive money normally straight away. But for services, you probably are on contractual terms. So it's the same amount that you would have received here, about 17,000 pounds, but it's received in a different manner where you provide the service, but you will receive a lump sum of 5,000 pounds. So this shows that in the first probably 2 months, you won't receive any cash from any of your customers, but going forward, you will be receiving cash, but the cash will be different to what your budgeting is. That's why cash flow forecasting is important. And that shows you how much exactly cash you need. So, for example, in the month of February, rather than the cost of goods is distributed throughout the whole year when you do it on your P&L. But when you actually on the actual cash terms, when you buy inventory, you buy in bulk. So you plot it in on the cash flow is based on the month that you bought it in. So based on your cash flow forecasting, you will know exactly how much cash you need on regular basis. Those are the cash that you'll be spending on, like rent. Again, here the rent is divided into all the months because that's what you pay for the whole year. But sometimes you pay the rent in lump sum. So in the cash flow, you will show the actual money that you've paid out through in the cash you paid out for that advance. So you probably paid for 6 months, you pay 5,600 pounds, another 4,800 for the next 6 months. So for cash flow forecasting will show you how much cash you need and how much net cash you're making on all of this. And based on this, then you can decide how much financing you need at the end. So those are the two tools and elements that are really helpful and useful. The first one, budgeting, helps you keep a control of your costing and your profits, and helps investors look at your business in a positive way. With the cash flow forecasting, helps you understand based on the budgets what will be your cash situation. So using these two tools, you'll be able to figure out how much cash do you need in your business. I think I mistakenly closed my window. Yeah, how much cash you need in your business, and how much you need to float, and how much you need to initially start. And those are the two tools that you can use. Now that you know how much you need, we need to find out what are the different types of finances that you can use to apply those and make it relevant for yourself. So for the initial investment, when you start a business, you can use your own personal money. So for example, you've been getting salaries, or you have some money saved up, you've already paid all of the taxes. That's the money in your pocket, and you want to use that to start your business. So there's a two-way that you can put your personal money into your business. One is loaning the business, and the other one is investing into the business. Now, loan is quite simple, it's straightforward. You put the money into the business. As long as it's interest-free, there will be no tax implication to it. You just put the money in. The business uses that money to buy inventory, pay the admin cost. And when the business has enough, you take the money out of the business, and that's it. You won't be asked to pay any tax because you've already paid tax on it, and you're not charging your company any interest on it. You can charge interest to your company, but that interest then becomes taxable because it's an extra income. So when you're starting a new business, loaning your company would be the most simplest and straightforward and less risk-free item. Investment is where you invest into the business and become an owner of it. So if you have, let's say, more than one people starting a company, the more you invest into it, the more shares you buy, the more ownership you get, the more voting rights you get. And in return, you get dividends, or when you sell the shares, you get capital gains. But both of those dividends and capital gains are taxable income. So a quick differentiation: loan does not give you any ownership, but it's tax-free and less risk-free. Where investment gives you ownership, but there are taxes if you take the money out from the business. So good things about taking a loan out, as I said, no tax implications, simple and straightforward. One thing, when you, for whatever reason, if the business didn't go and you end up declaring bankruptcy, if you have paid loan which you weren't able to take out before the bankruptcy, you will be in the list of priority to get that money back. So what happens is when a company goes bankrupt, there's a priority list. The creditors, the suppliers get the money first. So imagine the total debt is about £50,000, but the business can only afford 30,000 after selling all of its asset. That 30,000 will be distributed in a prioritization way. The creditors get it first, and then the shareholders are at the very end. So if you loan the company, then you will be one of the ones who will get the money first, compared to if you invested into it. The bad things about this, though, is it shows a big debt on your business. If you go to an external account lenders and ask them for to support your business, they will see your balance sheet and they will see there's a big debt, and that is the debt is from you to the company. So they won't like it. External investors and lenders prefer you take more risk rather than just lending the company. They will be like, if the business starts making money, who will get the money first, you or us? So it basically, in terms of the way, it does not look good on balance sheet because it shows your business in a negative. So my suggestion would be to, at a starting point, it's a good idea to start with the lending on your business, especially if you're a single owner. But once the business has enough, take the money out, bring your balance sheet in a neutral position, and then start external funding. If you're investing, however, the more you invest, the more shares you get, the more ownership you get, and the more voting rights you have. If there are more than one people in the business, the more you invest, the more shares you get, and the more power you get over the business decisions. Balance sheet will show positive figures. So even if you go to investors, they will see that there's more risk by the owner because they've invested a lot more of their personal money into it. And you will receive a consistent income. So whenever the business has any profits and dividends are issued, you will get a share of it. And the more shares you have, you will get more share of it. And the only risky part is that it involves risk. So you can end up losing that money, especially if it's after bankruptcy. So if you're planning to grow your business and would like others to get involved, investing in shares is a better option, and it shows trust and that your ideas are good, and it will attract other people to take those risks as well. Now let's jump into other types of financing. So friends and family. When you're starting a business, your friends and family would like to support you, and they will like to put money into you. So the option is suitable again to initially get support and to see if your concept is a success. So if someone from your family and friends can help you loan that or invest into it, and the same technicalities are involved. So if they're loaning you, the same situation, that they will loan the money to you, less risk. As soon as the business starts making money, they can get the money back. If they charge interest, the interest will be taxable. Otherwise, you simply return the money. If they're investing, same thing, they get more shares of your business, they get more ownership, more voting rights, more business decisions. For you, if you're getting loans from friends, remember on your balance sheet it will show negative. If they're investing in your business, it will show positive. It will show that people trust you, not only you yourself, but your friends and family trust your ideas as well, and they're investing into the business. So those are the two different ways how your family and friends can help you financing your business. Now let's talk about short-term loans. Once you've started a business, you have a good business plan, first few months are working out well, you can start going to the commercial banks and asking for overdraft. Overdrafts is really good for initial working capital. So if you have admin costs, if you want to buy goods initially, overdrafts are relatively less interest, and they give you a limit. So for example, for a starting business, they will say you can go overdraft up until £20,000 for this much interest. But if you obviously do bear in mind that if you pass the £20,000, it becomes really expensive. So again, it's a really good way to control yourself as well. So you know that this is your limit, and anything above this will be extra. But it gives you good initial understanding that you have some funds in the back if needed. Always pay your overdraft in time, because your credit history can become messy if you don't. But that's one of the initial and one of the easiest way to get on the borrowing side of things. Apologies. You can get some small cash loans. They are also called payday loans. If you are in need and you need to get that loan and get your business, keep your business running, you can get a small cash for your admin cost of the business. There are a lot of loan providers out there. I know in my previous job, we used to use this one loan providers for VAT. So every 3 months when we had a VAT due, we used to engage with them. They used to pay our VAT on our behalf, and then we used to pay them back in 3 months period. So there are loan providers outside for the businesses who wants to get a loan out for specifically things like paying taxes, and paying VAT or corporation tax. It comes with a reasonable interest rate because you're getting the loan in a very short term, and it builds a good portfolio for yourself as well. So those are some few small short-term cash loans that as a business that you can take out to run your business on day-to-day basis. Invoice financing is I think fairly not a new concept, but a lot of people are now getting involved into it. This is where, for example, when we looked at the budget, we saw that although you will be providing the service now and you have issued the invoice, but your customer will not pay you straight away, because you have a credit terms with them. They might pay you 3 months later. But that 3 months can be detrimental for you because you need to still pay your rent and expenses. But the terms you are with them, you cannot ask them for any earlier than that. And obviously, you have to build a reputation with them as well. So what you do is you get engaged with some of the invoice financing providers. I know Barclays does it. And what they do is that anytime you have an invoice raised to a customer, which will not pay you anytime soon, you give the invoice to these lenders, and they will pay you a percentage of it. So they will say, let's say, I'll pay you 92% of your invoice, but I'll own the invoice now. So you will get the cash straight away. And as soon as your customer pay the full 100%, that will go to the loan provider. So in this way, you're not owning anyone anything. You just owe the percentage of your invoice to them. But at least you get the cash straight away. So for a small percentage, again, I'll just give you a random figure, but for a small percentage, you can engage into invoicing, financing, and you can use this facility. Again, for small businesses and new startup business, this is a great way to support yourself in cash. There are two different ways of doing this. You can do for all of your invoices. So anytime an invoice is raised, you send them to your loan provider, and they will give you cash straight away for that while they wait for your customer to pay up. If your customer, for whatever reason does not pay up and it goes a bad debt, then it's their headache, not yours. So there are a lot of different terms and conditions to it. Just read them through. But this is one of the ways as well to support yourself in finances. Lastly, as you all know, you can get loans immediately for things like equipments, vehicles, advance rent payments. So you can engage those loan providers, and they will help you to buy, a car if you want it for deliveries, a packaging, equipments. You can get loans for those specific items with different interest rates. So moving on. So far what we've discussed is how loan works, what types of different loans are available for businesses, and how they help you with different aspects. The other way you can get financing into your business is by getting investments by externals. Now, as we discussed when we were talking about personal money loan into the business or investment, the logic stays the same. If you're going to external banks, commercial banks, asking for loans for all the options that we discussed above, the treatment is that you get the loan, you get the money in, and you start paying the money back in installment with some interest on it, right? So that's how the loan works. That's the common understanding. Investment is where you don't have to pay the money back. You are paying in return as an ownership of your business. That's why it's a bit more difficult to get it, because you have to have a very solid foundation and understanding of your business. But it's more lucrative in terms of cash, because you're not returning anything back. You just you get the investment, you use the investment to enhance your business. But what it does is it takes out the ownership from your hand. So rather than cash, it will take the ownership. So if you issue shares and you give 30% of your business for £50,000, you're losing the 30% right of your business. So any profit it makes, the 30% is gone to the investors for the money that you've got initially. So just be mindful of that element, and that's the difference between loan and an investment. Now, the first way you can go is crowdfunding. If you're a limited company, you can go public and make the ownership of your company public in return for investment from public. This will only work if your business idea is great and has a great potential and will attract general public. What it does is your ideas, your balance sheet, and your books will go public. People will decide if this is a good shares. They will invest into it, and you can dilute your shareholding to a very small amount, where people will pay a small amount to get a very small chunk of your business. But when you look at the big number, it's you receive a lot of funding in return. Good thing about this is that with a great pool of different individuals investing in your business, it means that it's kind of a free marketing. The more people you reach, the more publicity it's your business, and obviously in return you're also getting cash for it as well. And the cons about it is one of the other good things is, because you're diluting your shareholding and your ownership, it also dilutes the risk. If a business makes a loss, then the loss is then distributed to all of the people involved in it. But again, as I said, diluting your ownership means that you're also diluting any profit that you'll be making in the future. And it's a bit of a hard process, and it requires a lot of publicity. It's not simple and straightforward of going public. You have to have a good business project and an understanding that this is what is on offering for the general public. Similar to this, you can also go for angel investors. Everything is same as public funding. The difference is, rather than going to a public and big numbers of people, you actually go for a person who is private investors and have high net worth and who like investing into startups and entrepreneurs in exchange for ownership on your business. So again, same thing, you're approaching an external individual to get investment into your business to start. But you're giving up your ownership in return for that money, and the only difference is you're not going public, you're going to individual person. Until you know someone, you can hire agents to introduce you to these investors, and the agents will also assist you in terms of negotiating these key terms. So there's a whole ecosystem where you can get this. And it helps you to get different ladders and different angel investors. But my point is to tell you how it affects your business, and it affects by taking ownership from you, but also taking some risk away from you and give you that cash in advance. There's a bit of a help from the government as well. So there's a startup loan from British Business Bank scheme, mainly aimed for individuals who have not been able to secure funding from anywhere else, but have great ideas. So you again have to have a good business proposal, and you have tried every other venue, and that didn't work out for you. So you can approach the British Business Bank scheme. You can borrow up to £25,000 with 12 months mentoring session as well. So the whole loan that you buy up to £25,000 is fixed on a fixed rate for 5 years. What they do is, for the first 12 years, they give you expert mentoring sessions as well to help you with your business. So you're not only getting the money, but you're also getting some expertise from them as well. There's no arrangement fees. And you can even use this loan to buy an existing business or start a franchise. But it's a really good way to get involved and get some expertise on your end. But there's a strict criteria to meet. One of the current criteria for COVID was that people who got laid off from their job because of COVID, and they have now a really good idea that can develop into a business, they got this quite easily. And on regular basis, anyone who can apply for this and does apply, is applicable for it, can avail this option as well. So what we have looked so far is why financing is an important element, how to determine how much actually do you need on regular basis by looking at budgeting and cash flow forecasting, what are the different options for loans and short terms and long-term loans, and what are the different options from investment side of things, and how all of that actually affect your business. Now, what we're going to look at now is how it actually affects the accounting and tax side of things. So from the loan perspective, if you take a loan out of your business, anytime you pay any interest on that loan, that interest goes against your profit and loss. So imagine you take a loan out of for £10,000 for 12 months, and the interest that you will pay on that is £2,000. So in total, you have to return £12,000 for that £10,000. That £2,000 extra that you're paying is interest, and that interest will go against your profit and loss, which will reduce your sales, which means less corporation tax. So when you're paying the £2,000, remember, you're not just, that £2,000 is not a complete loss. You're saving on corporation tax on it. On your balance sheet, now balance sheet is an item that shows the worth of your business at any given point in time. Actually, it's worth just mentioning what these three things are. So profit and loss is the performance of your business on regular basis. So if you look at on 31st of March on your profit and loss, it will show you on 31st of March what your business did up until now in terms of profit and loss. Balance sheet shows the performance of your business at any given point in time, which means what your business holds as a value, what are the debts, and how much is the total equity. So if I'm looking at your balance sheet, I'll see that at this point in time, this is the worth of your business. This is how much, this is the position of your business at this point in time. And cash flow statement, as we mentioned, shows what cash flow you have, how much cash flow you would be giving out in next few months. So coming back to the loan side, the way loan affects your accounting is it shows interest on your profit and loss. Balance sheet shows the £10,000 outstanding, and it divides it into different sections, long term or short term. And cash flow will show how much cash you should be paying out in the next 12 months based on the loans that you've taken out. Tax implication, the interest that you have paid on the tax is a taxable income, and as I said, it's corporation tax deductible. The loan repayment that you're paying has no tax implications. So the £10,000 you got, and when you're returning the same £10,000, you will there will be no tax implication. It's just a balance sheet item. Now, accounting and tax implications for investment. So when someone invests in your business, when you receive the money as an investment, there's no implication on your profit and loss because it's not a taxable item, and there's nothing charged to you on top of it as well. It's only an equity that goes away. But when you pay out dividends, so for example, you made a profit of £10,000 and your investors now owns 20% of your business, you will pay them £2,000 in dividends. That dividend will go out of after profit tax from your P&L, but there's no tax implications to it. Balance sheet shows a positive figure on how much investment you have in your business, and it will show you the net worth of your business. Cash flow will show the cash investment coming in and the dividend that you might pay out if you have enough profit making in the business. So that's the accounting side. The tax implication is the investment that you receive is, as I said, is a non-taxable item. There's no tax implication to it. But the individual who is investing and any income that they receive or in return for it is a taxable item. But for you as a limited company, it does not have any tax implication. So after going through this whole webinar and trying to understand, how, what options, and the different resources we have, what I would suggest you to do next is to firstly always try to understand your numbers. It's crucial that you know what your business is, can be, and is capable of going forward in terms of numbers. Do that by budgeting, forecasting, and cash flow understanding. And the Google sheet that I made is available for you, so please feel free to use it and change the figures around and add these items to it. But knowing this is really important because not only for you personally, but as I said many times in this presentation so far, that anytime you go out to buy, to get some lending and to get people involved, they will always want to see your budgeting, your forecasting, and that will also explain how good you understand your business. Analyze your current stage of the business and select appropriate financing as discussed. Understand how each option can affect your business, accounting wise, tax implications. If you're taking a loan out, remember, if you take a loan out now and you think that you will also need another loan in next 5 months. If you already have a loan on your balance sheet as a negative figure, remember 5 months later it will be difficult task to get it again. So decide then, would it be better to get an investment in rather than a loan? Take the risk for yourself if you think the business can afford it. Understand your tax and accounting implications. Maintain accurate bookkeeping. So this is the most crucial part, and this is where I would like to share the screen again on the budgeting side of things. So if you are doing and maintaining your regular day-to-day bookkeeping, what you can achieve is, for example, you on the first day you sat down, you created this whole budget, you created this whole cash flow, and now you're doing your bookkeeping on a regular basis. End of March, and you did your bookkeeping, and it turns out you only sold £2,500 worth of goods, and you did not make any sales on your services, right? So what this will show is that accumulating all of this, compared to the 4,000 that you assumed, you only made £2,500. So there's a big difference, of £1,500 worth of difference. You then need to change your figures again and see what the actual reality is. And initially you thought you will make £4,000, you only made £2,500. What's happening? What's going wrong? Is your marketing not working? The people who have been engaged, like influencers and stuff, are they not doing as promised as they would? So if you're doing a regular day-to-day bookkeeping, it will help you to keep on top of your budgets and see where are the big differences. Imagine you're doing your day-to-day bookkeeping and then you ended up spending on utility bill £500 that month. When you initially planned, you only thought it will take £200. Why is it charging you £500? Why did you get a bill of £500? You will have to immediately look at it and see where it's going wrong. And that's where you need to make differences and changes, like are you paying for extra utility bill that you didn't encounter in first place, and then change all of the figures straight away. So what it does is it helps you. If you do the regular bookkeeping and you keep updating your budget and your cash flows, it helps you understand what you aimed your business to be and where your business is going to. And if there's a big difference, then you need to suddenly stop. You need to stop and go to the drawing board again and see what went wrong and how to fix it. But if you don't do your day-to-day bookkeeping and you just go through each invoices, trust me, at the month end, you have gone through so many invoices, you've gone through so many business difficult decisions to make, that you will not be able to maintain on top of your head of how much each is costing you. You need a system in place to help you make those decisions for you, so you can focus on bigger things. And if you're doing bookkeeping on a day-to-day basis, that's what it will help you with. Again, with that, with accurate day-to-day bookkeeping comes plan and control on your business and strategic decision making, and then understanding how these options affect you personally. Great stuff. So that was a short webinar. Not sure, I think it was quite long. But upcoming webinars, we have how to ace forecasting and growth of your business on 15th of June, 22nd of June, e-commerce made easy, and on 29th of June, online marketing pros, cons, and key considerations. Please get in touch with the council to help you sign up for these for future webinars.